So let's proceed from where we left in our last session. So let's go to the next question. That is number 30. Okay, a company uses an overhead absorption rate or AR of 350 per machine hour based on 32,000 budgeted machine hours for the period. During the same period, the actual overhead expenditure amounted to that, and 30,000 machine hours were recorded in actual production. By how much was the total overhead under or over absorbed? So we want to calculate the overhead absorption, whether there was an under or there was an over absorption. So we want to calculate whether there was an under or over absorption. So, sorry, can I just answer the call? Hello? Hello? Tunafara Makadiyo. Right here, Sundian. All right, it's fine. Can you send me a message? Can you put a live lesson online? The first lesson will run half one, so maybe you can try that time. All right. Okay, let's proceed. Sorry about that. So a company uses an overhead absorption rate, OAR, of 350 per machine hour based on 32,000 budgeted hours. So what do you need to do here for us to be able to calculate whether there was over or under absorption? We need to use the following. So that's today is day 3. So when you're calculating over or under absorption, if there is an over absorption, it means we have over budgeted. Our budget was actually above the actual result. So over absorption is more like over budgeting. Under absorption is more like under budgeting. So if you are calculating over or under absorption, we start with the budget. So we can say the budgeted overhead of actual hours. Budgeted overhead of actual hours. So we're looking at the budgeted overhead for the actual hours. Then you less the actual overhead. So the budgeted overhead of the actual hours less the actual overhead. So the answer that you get, if it's a positive, it's over absorption. If it's a negative, it's under absorption. So the answer we get is either over or under absorption. Let's move on. So if you're looking at the budgeted overhead of actual hours, so we are taking the budgeted. So first of all, we are saying we had budgeted that each hour is going to have this amount of overhead. So from our budget, we had from our budget tatakagadzira isusu kuti each hour each consumer overheads akawanda sei, which is our overhead absorption rate. So the budgeted overhead yatinayo per hour. So the budgeted overhead per hour tatakabhajeta kuti for every hour tichaita cost yemari, that is equal to our overhead absorption rate. So the budgeted overhead per hour is equal to our overhead absorption rate. So the first step, you calculate your OAR, you calculate your overhead absorption rate. That is the budgeted overhead per hour. Then you multiply that with the actual hours. So you're taking the budgeted overhead, you multiply that with the actual hours. So the first step is to calculate our overhead absorption rate. So our first step is to work out our OAR. So this will give us how much we are budgeting for every hour. So that is our budgeted cost per hour. So if we calculate our OAR, this will tell us how much we are budgeting for every hour. So let's go to the question and work out the OAR. OAR, by the way, is calculated by saying the total budgeted overhead over total hours, total budgeted hours. Total budgeted overhead over total budgeted hours. That's our OAR, the total budgeted overhead over the total budgeted hours. So this will give us our overhead absorption rate. So now, if we're going to apply that to the question, notice our total budgeted overhead. How much is the total budgeted overhead? Our total budgeted overhead, a company uses an overhead absorption rate of 350 per machine hour based on 32,000 budgeted machine hours for the period. During the same period, the actual total overhead expenditure amounted to that. So we are told that the OAR is 350. We have already been given our overhead absorption rate. So we're not calculating the OAR, but we have been given the OAR. So the OAR is saying is 350 per machine hour. We are budgeting every hour ishaita ma overhead at $3.50. That's our budget. Every hour ishaita ma overhead at $3.50. But takazoita ma hours mangani. So kuti tiwane the budgeted overhead. Kutizokwanisa calculate OAR tauda the budgeted overhead. Sorry, budgeted, yes, budgeted overhead in total. So that she budget out every hour. Overhead cost ninge 350. That's the OAR times tazoita ma hours mangani. So wangochi budget a cost of 350 per hour. Wazoita ma hours mangani. So apatazonzi susu during the same period, the actual overhead expenditure is that, and 30,000 machine hours were recorded. So isusu kanataka kutsvaga our overhead absorption, sorry, kanataka kutsvaga our budgeted overhead. Trikuti, tataka budget at $3.50 per hour times the actual hours atazoita. So zvichireva kuti kana wanga uchibudget at $3.50 per hour, you wozoita actual hours, wozoita ma hours 30,000. What would have been your budget for the 30,000 hours? So you are not using the budgeted hours, but we are using the actual hours. Kana pakutsvaga OAR ndopa unoshandisa the budgeted hours. But kana wakuda the budgeted overhead, urikuti OAR times the actual hours that have been used. So tikuti tataka budget at 350 per hour, sikatazoshandisa 30,000 hours. So for 30,000 hours, what would have been our budget? So meaning for 30,000 hours, our budget would have been 105,000. But this is different from the actual overhead. The actual overhead, we are given the actual overhead being, let's go back to the question. So the actual overhead we are told is 108,875. 108,875. So that's our actual overhead. So meaning that we say this minus this one, which means there's an under absorption. So our overhead absorption rate, there is under absorption of 3,875. So if it was a positive, it would be an over absorption. So what is key of noting here is first tangochaga OAR. OAR are not the budgeted overhead over the budgeted hours. One OAR, that OAR, one of the budgeted overhead, we are going to use for calculating over or under absorption. And then go to multiply the OAR times the actual hours, not the budgeted, times the actual hours. Then you compare that with the actual overhead. Now, let's move on. Which two of the following statements relating to management accounting information is true? So remember, we have financial accounting information and with management accounting information. So take note of the differences. If it's management accounting, it's more about telling us the future of the business. Management accounting, this is more of preparing, using what has already happened to prepare of our next move. But financial accounting is telling us the past, how we have performed. For management accounting, it's not a force matter that a company should have management accounting records. So for management accounting, it's our own choice to have the budgets. It's our own choice to have the cost information. But as for financial accounting, it is a prerequisite. Every company should prepare the financial statements. And for financial accounting, there are set standards that you're supposed to follow. Unlike for management accounting, there isn't any really set standard that you're supposed to follow when preparing the accounts. So now from the list we have been given, we have to pick which characteristics are pertaining to management accounting. So number one, it is produced for parties external to the organization. That's not true. Management accounting is needed by managers who are within the company so that they can make future decisions regarding the company. So it's not for external reporting. Financial accounting is the one that we tell those that are outside the company. Management accounting is normally for internal use, for internal reporting. There is no need of telling those outside the company our budgets and our plans. So the first one shouldn't be correct. Then it may be presented in monetary or non-monetary terms. Yes, management accounting can look at both monetary and non-monetary aspects. So if you're talking about monetary and non-monetary aspects, as we are making the plans, because management accounting makes the plans for the business, the future plans, we can consider factors such as competition when you're making these future plans. When you're making the future budgets, you can consider things such as the demand, the customer demand. So we can incorporate non-monetary issues when we are preparing these budgets. No strict rules govern the way in which information is presented. Yes, that's true. When you're preparing management accounting records, there isn't one hard and fast rule on what you're supposed to do. So a company can prepare a budget in various formats according to how they want. So there aren't strict rules on what is supposed to be done. Then there is usually a legal requirement. That's not for management accounting. Legal requirement, that is for financial accounting. not management accounting. So that's another point to take into account there. Then now let's move on. Let's move on. A company's sales in the last year, in its three different markets were as follows. So we're given the sales that were made for market one, for market two, and market three. In a pie chart, so this is representation of data. So in a pie chart, representing the proportion of sales made in each market, what would be the angle of this section representing market three? So we want to represent the information on a pie chart. We want to represent the information on a pie chart. So if we are representing the information on a pie chart, remember a pie chart expresses the information as a percentage of 360. So we need to present the information in degrees. But presenting the information in degrees, you say, for example, market one, you say the sales for market one over total times 360. That's how you get the degrees for market one. But in this question, they're asking for market three. So you'd say the sales for market three over the total sales times 360. So sales for market three, which is 51 over 300 times 360. So to calculate the degrees there, so if you're working out the degrees there, you would say the sales, that's the 51,000 over the total, which is, so that's 51,000 over the total, which is 300,000 times 360. So for a pie chart, you multiply by 360. So that would be 51,000 over 300,000 times 360. So was it 612 degrees? That one is not possible. I think I made something. Let me check the amounts again. It's 51 over 300 times 360. Let's redo that calculation. It can't give me that amount. Let's redo that calculation just a moment. So we are saying supposed to be 51,000. I had written, it meant a lot of zeros there. So that's 61.2 degrees. So to the nearest degree, that's 61 degrees. So correct answer there is supposed to be 61 degrees. That's it. So a pie chart expresses the information as a percentage of 360, or we multiply. So we say if it's 51 over the total times 360. For market two, that's 149 over 300 times 360. Now let's move on. Main source of data can be classified as social and machine, social, machine, and transactional data. So we can either get information from social data, that is human data, then machine, that is sensor data, or transactional data. Which of the following would be classified as transactional data? So this is data derived from transactions. So if it's social data, it's looking at the data that is looking at, or we can say maybe data obtained from the social behaviors, the social medias, that can be classified under social or human behavior data. So this data tends to be studying how the behavior, how the how the population is behaving. Then the machine data, this is extracted by the machines. Then transactional data, it can be generated from our day-to-day routine transactions. So we have a purchase order, a GPS vehicle tracking system, a content of a blogger. That one is content of a blogger, that's social data. Then the output from fitness tracker. Output from a fitness tracker, that one should be a machine that is deriving that data. So that one is machine sensor. Then which is likely to be from our daily operations there. So looking at that, what can be is, which one can be part of the transactions of the business? What's your take on this one? So I think it's the purchase order, because when we make transactions, yes, Faith is saying A. I also support A, because the purchase orders are from our daily transactions. So transactional data should be from our regular day-to-day transactions. Now let's move on. The purchase price of an inventory item is 25 per unit. In each 3 months period, the usage of the item is 20,000 units. The annual holding cost associated with 1 unit is 6% of the purchase price. The cost of placing the order is 20. Then the question is saying, what is the economic or the quantity? What is the economic or the quantity? So remember, the economic order quantity, the formula is the square root of 2 cod over CH. So that's the square root of 2 times cost of ordering times demand over holding cost. That's how we work out so the economic order quantity. So our economic order quantity, that's the square root of 2. Let's first of all multiply the items inside, then we get the square root in the end. So it's the square root of 2 times CO. CO is the cost of ordering. So 2 times CO, which is the cost of ordering, times D, which is demand. Then we divide all this by CH. We divide that by the cost of holding inventory. So let's first of all calculate that's 2 times the CO is given. I'm sure the cost of ordering is given. How much is our CO and how much is our D? How much is our CO and how much is our demand? Let's be fast, please. Remember, let's do it together and move fast. Remember, if we are looking for the D, is the demand for the year. The CO is given. The cost of ordering is 20 is given in the last statement. Then the demand is the annual demand. So the 20,000 units are said to be the units for 3 months. The question is saying in each 3 months period, the usage is 20,000, of which we want the demand for the year is the annual demand. So if in 3 months, we need 20,000. How many 3 months do we have in a year? We have 4 3 months. So it means the annual demand, we will say the 20 months, the 20,000, 20,000, 20,000 4 times. So it means in a year, we need 40. we need 20 times 4, which is 80,000. So our demand is 80,000. So our CO is 20, our demand is 80,000. Then we divide by CH. CH is the cost of holding stock. So remember, what is the economic order quantity? So the economic order quantity, we're saying how many units should we buy, which minimizes cost of placing an order and cost of holding the inventory. Okay, let's finish up, then we'll discuss on that. So the CH is the cost of holding the inventory. So how much is it to hold each unit of inventory? So the question is saying that the annual holding cost for each inventory unit is 6% of the purchase price. The purchase price is 25. So the CH, the purchase price is 25. The CH is 6% of 25.
$50.
$50, thank you. So can you now then simplify this? First, then we put it in the square root. What do we get if we say, no, let's do it together here. So that's equals 2 times 20 times 80,000 over 6% times 25. Then we say the square root of this. So we're saying the square root Okay, can you quickly work out that? What's the square root of that? Yes, I'm failing to put the function there. What's the square root of that? Is my calculation correct here?
Yes, that's also what I got.
I think the first one, I had made an error on the first one there. So the answer is supposed to be roughly, that's 1.46. So 1.46 to the nearest whole number, 1.461. So 1.461. So this one, that's our economic order quantity. So what is the economic order quantity? The economic order quantity, we are saying how many units should we buy in order to minimize. So this is the quantity that minimizes. Ordering and holding costs. There are costs of inventory associated with, if we place large volumes of orders, we are likely to have a lot of inventory in our warehouse. So if we buy a large volumes of orders, we are likely to incur holding costs. But if we buy small orders, our frequency ticharamba tinohoda every time tetiri muroad tinohoda. So kunoisa maorder mashoma kune macost ekuramba transport tinotenga. Kuisawo maorder akakura kune cost storage. So which quantity then minimizes the cost of placing the orders and the cost of storage or of holding the inventory? That's the economic order quantity. It minimizes the holding and ordering costs. It's the quantity that minimizes the holding and ordering costs. Then from there, let's move on. Let's try that. So it was 1461. Let's go and try that on our answers. So let's move. The results of a chemistry examination are normally distributed with a mean of 56 and a standard deviation of 12. So the distributed probability distributions. So we can have the data being normally distributed. We can have the data being binomially distributed. We can have it following a Poisson distribution. So if the data is normally distributed, how do you work out the probabilities? So in normal distribution, we have the standard normal distribution. The standard normal distribution if the data is the standard normal distribution, it means that, okay, we can say the standard normal distribution has a mean of 0 and a standard deviation of 1. It has a mean of 0 and a standard deviation of 1. So normal distribution, we say X, if that's the data we are modeling, X is normally distributed with mean and standard deviation. With mean and standard deviation. So if the mean is 0 and the standard deviation is 1, we say that one is the standard normal distribution. If it's distributed in a manner that our mean is 0 and our standard deviation is 1. So this is said to be the standard normal distribution. It's said to be the standard normal distribution. So for the standard normal distribution, if we are getting the probabilities, to get the probabilities for a standard normal distribution, we use the tables. So to get the probabilities for a standard normal distribution, I will simply go to the tables. So we go to the tables and use the table. So if it's the probability of less than, if they say what is the probability that X is less than a certain number, let's just give that number A. You go to the tables and you simply get table value or table entry A. So if it's less than, you're just going to the tables, you get the value of A. If it's less than, you go to the tables, you get the value of A. And less than is the same as greater than negative. So less than is the same as greater than negative. So let's say the question says, what is the probability of X is less than 1.3. If it's less than 1.3, you go to your tables. Let's go to the tables, the normal distribution tables. Why am I taking time with this? I think a lot have mentioned that they are facing challenges on that one. So I need to take it slow. Need to go slow there. So this is the standard normal distribution table. So if it's 1,3, it's 1,30. It means you're going under 1,30. It accommodates two decimal places. If it's maybe 1,35, you say 1,3 under 5. So ours is just 1,3. So it's 1,30. It's 1,3 under 0. So you take the value 0.4032. (0.4032). That would be the probability. The same goes if it had said greater than negative. So if it says greater than negative, it's the same as less than. Let's say if it had said greater than negative minus 1.3, we'd do the same. What about if it's what if the question had said, what is the probability that X is greater than positive A? Or this is the same as X is this is the same as probability that X is less than minus. So if it says greater than, we are going to say 0.5 minus the table value, table amount, or table entry A. So for example, if the question had said the probability that X is greater than 2.14. X is greater than 2.14. We go to the table and we identify 2.14. Oh, sorry, we said if it's greater than, you're saying 0.5 first minus table value of 2.14 table value of 2.14. Table value of 2.14, so we go down with the table. 2.1 under 4, so that's 2.1 under 4. 2.1 under 4, so this is 0, 2.10, 2.11, 2.12, 2.13, and 2.14. So it's 0.4838. 0.4838. 0.4838. So it means our answer would then be that 0.5 minus 0.4838. Then the last case would be probability of from A to B. So you are given a range, probability that X is from A to B. You say table value of Chirikumberi. So you're saying table entry of B minus the table entry of A. So if it's given a range from A to B, you say value Chirikumberi minus the value Chirikumberi. So that's in brief. That's in brief. But this is provided the data is normally distributed with a mean of 0 and a standard deviation of 1. What if it is not distributed that way? If the mean is not 0 and the standard deviation is not 1, if the mean is not 0, or the standard deviation not 1, the first step is to standardize. The first step is to standardize the data. We do what we call standardizing the data. Standardizing the data, we use the formula. You standardize the data to Z using the formula. Unfortunately, I don't have the mu here, but you can say the mean, you say X minus mean over standard deviation. So you say X minus mean over standard deviation. Let's go to our data that we were given on the question. The data we are given, the mean is 56 and the standard deviation is 12. So this one is not standard normal. It's not standard normal distribution. So the first step is to change it to standard normal. How do you change it to standard normal? X is the value that we are looking for. We are looking for probability that, what is the percentage probability that the student will score more than 80? So the question is saying, what is the probability of scoring more than 80? Probability that the X is greater than 80. If it's not standard normal, if the challenge is we don't find 80 on the tables. We can't go to the tables and get 80. So this one is not standard normal. Our mean is not 0 and our standard deviation is not 1. So when you're standardizing, you are reducing this value so that we can be able to get it on our tables. So when you're standardizing, you then say the X changes to Z. Then you say greater than. Now you apply that formula. So Z is equals to what? We say the X is the value that we had, the 80, minus the mean, which they had given you. What was the mean on the question? The mean on the question is said to be 56, standard deviation is 12. The mean is 56 and the standard deviation is 12. So you say X minus mean, that is the 80 we're looking for, minus the mean 56 divided by the standard deviation 12. So can we reduce this together? Please help me out. I want you to simplify this side where we have 80 minus 56. So you say 80 minus 56, then you divide the answer by 12. What do we get? 80 minus 56 to divide by 12.
2.
It's just straight 2.
Yes.
So now we have reduced, it was the probability of 80. Now it's 2. So it's easier now to get this one from the tables. So the Z is the standardized value of X. So now remember, from now we can use the step I showed you here, that if it's greater than, probability of greater than, we are now saying what? If it's greater than 2, because 2 we can get 2 from the table. So you say for greater than it's 0.5 minus the table entry 2. So you're saying 0.5 0.5 minus, let's go and find the table entry 2. So 2 is just 2.00. So it's 2.0 under 0. That's 0.4772. 0.4772. Zero 0.4772. So that becomes 0.5 minus 0.4772. So that would be the probability. But the question said percentage probability. So this one is a percentage. If you are changing this to a percent, you multiply by 100. So, but I can, with my Excel, I can quickly do that. Just come here, you click the percentage. So that would be 2%. You can multiply by 100 to change to percent. So that would be 2.28%. So that's 2.28%. So that's what they were asking. So if this is not standardized in a way where X is, the mean is 0 and standard deviation is 1, you then have to first of all standardize. The question had say to 2 decimal places. Section B, Cape Company owns and runs 350 taxis and had sales of 10 million in the last year. Cape Company is considering introducing a new computerized tax tracking system. The expected costs and benefits of the new computerized tracking system are as follows. The system would cost 2.1 million to implement. Depreciation would be provided at 4.2 per annum. 75,000 has been spent on staff training in order to evaluate the potential of the new system. Further training costs of 425 would be required in the first year if the new system is implemented. So the system requires 2.1 to implement. Depreciation would be 420. Then training costs have already been incurred for 75, and further training costs of 425 are yet to be incurred. Sales are expected to rise to 1 million to 11 million in a year if the new system is implemented, okay? Thereafter, increasing by 5% per annum. Year one, the sales are expected to rise to 11 million, then increase by 5% thereafter. If the new system is not implemented, sales would be expected to increase by 200,000 per annum, okay? Despite the increase in sales, savings in vehicle running costs are expected as a result of the new system. These are estimated to be 1%. The 6 new members of staff would be recruited to manage the new system at a total cost of that. Cab company would have to take a maintenance contract for the new system at a cost of that. Interest on money borrowed to finance the project would be that. Okay, so what are the questions ready? Okay, in order to determine whether the computerized tracking system should be introduced, indicate whether each of the following is a relevant or irrelevant cost. So if you are making a decision, there are certain costs that are regarded as being relevant costs, and there are certain costs that are irrelevant. So we have relevant costs and we have those that are irrelevant for decision making. So for a cost to be a relevant cost, for a cost to be regarded as a relevant cost, what are relevant costs? These are future costs that will result in cash outflow. You can say future incremental costs. Future incremental costs. These are future incremental costs that will result in a cash outflow. So if you are looking at relevant costs, number one, they should be future costs. By them being future costs, the relevant costs must be incurred in the future. If a cost has already been incurred, it's no longer a relevant cost for decision making because it will not change whether you choose to go ahead with the decision or not. A cost that you have already incurred is no longer relevant. If you are now deciding, should I continue to do acca or should I now do CIMA? You can't start calculating the cost of tuition that you have already paid. That one is an irrelevant cost because whether you choose to go for CIMA or for acca, that cost, you cannot avoid it. You have already paid for it. So a relevant cost is a cost that you will pay for in the future. That is the one that is likely to affect your decision. A cost that you have already incurred in the past is not relevant. It's called a sunk cost. It is not changed by the decision. A relevant cost must be a future cost. A cost incurred in the past already is called a sunk cost. a cost already incurred, is called a sunk cost, and it is not relevant for decision making. Then, besides the relevant cost being a future cost, it must also be an incremental cost. So a relevant cost, we are saying this cost is going to result in our costs increasing. So if it does not change our cost, like if it's a fixed cost, it's not relevant. Because of course we'll pay rent in the future, but if we are going to pay rent whether you have made the decision or not, then that one is not a relevant cost. A relevant cost should result in an increase in the cost that we are currently paying. So it must result in an increase in the cost that the business is paying. That's a relevant cost. It should increase the cost that we are paying. Then the relevant cost must also be a cash flow cost. For decision making, relevant cost must be a cash flow cost. Like depreciation is not a relevant cost. Why? It's not a cash item. So relevant costs should result, these should result in us paying money. These should result in a financial outflow. These should result in cash outflow. So they must result in us losing money as a business if they are relevant costs. So these are the characteristics of relevant costs. Now, let's go and apply these characteristics to our question. So if we go to the first one, computerized tracking system investment of 2.1, is this relevant or not? So we want to make the decision of this new computerized tracking system. The system would cost 2.1. Is the 2.1 relevant or not? What's your take on that, please? Would it be relevant? It's relevant because it's a future cost. It would cost. So because it's a future cost, is relevant. Then depreciation of 420 in each of the 5 years, relevant or not relevant?
Not relevant.
Not relevant because depreciation is not a cash flow cost. Relevant cost should be a cash flow cost. Staff training cost of
Not relevant.
Said what? Staff training cost of 425? The staff training cost of 425, relevant or irrelevant?
Relevant.
It's relevant because they so far they've spent 75 and they are further going to spend 425. So the 425 is a future cost. So it becomes
relevant
because it's a future cost. New staff, total salary of 120. Salary for new staff. Six new staff would be recruited to manage the new system. So is it relevant or not relevant? It's relevant, yes, because it will increase our total cost. It's incremental.
relevant
is relevant. It will increase our total cost. What about the staff's training cost of 75 that we have already incurred? 75 has already been spent.
Not relevant.
Irrelevant, yes. Interest of 150 per annum would need to pay interest. So the question was saying, let's go to, oh, the interest is actually there.
Relevant.
Okay, so for the interest, unfortunately, the interest on money borrowed to finance the project would cost, the interest in this case is the cost of capital. This one is an irrelevant. It's not interest of the money. This one is the cost of capital. So this one, cost of capital, is irrelevant cost. So now let's move on. Calculate the following values if the computerized tracking system is implemented. The incremental sales. So if we are to go ahead with the computerized tracking system, the incremental sales, we are saying the sales are going to increase by how much? So the incremental sales, provided that the system has been implemented. So the incremental sales would say, let's look at, we're told that let's go to the question first, where there was something about sales. Sales currently they are 10 million. Last year they were 10 million, and they are expected to rise to 11 million. They are 10 million, they're expected to rise to 11 million. And if we don't implement the system, sales are still expected to rise to 200. So we can say sales expected after new system is 11 million. Then sales with the old system. So they were 10 million last year, and they're expected to rise by 200. So it was 10 million, they're expected to rise by 200,000. So that's 0.2 million. So it means the sales are expected to be 10.2 million. With the old system, 10.2 million. So the incremental revenue, if the new sales, if the new system is implemented, is 800,000 or 0.8 million. Because, yes, Mr. Barry?
No, it was just a mistake, sir.
Okay. So 800,000. Because they were saying even with the old system, the sales will be expected to rise by 200. But for this one, the sales will be 11 million. So the overall incremental revenue is 800,000. The savings in vehicle running costs. The savings in vehicle running costs. So the savings in vehicle running costs, what was the issue on vehicle running costs? Let's check the vehicle running costs. Did they mention? Despite the increase in sales, savings, that's item number 5, savings in vehicle running costs are expected as a result of the new system. These are estimated to be 1% of total sales. So the savings in vehicle running costs are expected, and they are 1% of sales. So this one is an easy one. So they've said the savings are 1% of the sales. So if the new system is introduced, the savings will be 1% of 11 million. So 1% of 11 million, 10% we remove 1 0, 1% we remove 2 zeros. So that's about 110,000. So the savings were 1%. So you just calculate the 1% of the sales. Then the next one is saying, what is the present value of the maintenance cost over the life of the contract? The present value of the maintenance cost. What was the issue about the maintenance cost? So with item number 7 there, item number 7 is saying that CAPCO would have to take out maintenance contract for the new system at a cost of 75,000 per annum for 5 years. So we're taking maintenance at 75,000 for 5 years. $75,000 for 5 years. Then the question is saying, present value of the maintenance over the life of the contract to the nearest 000. Okay. So if we are using, I think let's use their tables. They are what we call annuity tables. If there is a certain amount that you are receiving for each year for 5 years, to calculate its present value, we can use the annuity tables. So let's go and check using the annuity tables. So we are receiving 75. In fact, this is a payment for maintenance, 75, 75, 75 for 5 years. So the present value, if the amount is the same for 5 years, you can use annuity. If it was different amounts, you'd need 75,000 year 1, you multiply by discounting factor for year 1, 75 for year 2, you multiply by discounting factor for year 2. But since the amount is the same, the faster way, if the amount is the same that you're receiving over 5 years, instead of calculating the discounting factor for each year, you use the annuity tables for 5 years. So the cost of capital, I think it was said to be 10%. So you come to the annuity table for 10% year 5. 10% year 5 is 3.791. 3.791. So present value of 75,000 paid every year for 5 years. We can use the annuity tables. Since the amount is the same, if we were paying different amounts, we would need to use the discounting factors. You discount for year 1, year 2, year 3, year 4, then you add up the discounting factors. But if it is the same amount, the faster way of getting the present value, if it's the same amount, you multiply by the annuity factor. So for 5 years, it was, I think, 3.791. So this will give us the present value of what we would pay. So we're saying 75,000 times 3.791. So that would be 284325. Let's go and check this, try this one. Because 284 what? 284 the 325. 284325. Oh, the question had said to the nearest thousand, but still we got it marked that correct. Let's. Cape Company wishes to maximize the wealth of its shareholders. It has correctly calculated the following measures for proposed computerized tracking system. The internal rate of return, IRR, to be 14%. The return on capital employed to be 20%. The payback period is 4 years. Which of the following is true? Which of the following is true? The project is not worthwhile because the payback is less than 5 years. The project is worthwhile because IRR is a positive value. The project is worthwhile because IRR is greater than the cost of capital. Yes, we prefer a project with an IRR, the internal rate of return, greater than the cost of capital. That is the correct one there. The IRR, the project is doing well if the IRR is greater than the cost of capital. Now, let's look at the next question. Castilda Company manufactures toy robots. The company operates a standard marginal cost system and values inventory at a standard cost. The following is an extract of a partly completed spreadsheet for calculating variances. The following is an extract of a partly completed spreadsheet for calculating variances. Which formula will correctly calculate direct labor efficiency variance? In cell B18, direct labor efficiency variance. Direct labor efficiency variance. So the labor efficiency, remember for labor efficiency, we are looking at the use of, we are looking at being able to use labor fewer hours than budgeted. If labor is efficient, they are using less hours than budgeted. So for our labor efficiency variance, before we maybe look at their answers, so what can we say about the labor efficiency variance? So for the labor efficiency variance, so our labor efficiency variance, we say the standard hours minus the actual hours times the standard rate. This, if we open bracket, those that did maths, this is the same as well with saying what? This is the same with saying standard hours, because what is outside the bracket multiplies everything inside the bracket. So it's the same as standard hours times the standard rate minus the actual hours times the standard rate. So we don't know which one they gave us there, but both can work. Or optionally, we can say, still the same formula that I'm just breaking down. Is the standard hours times the standard rate. Standard hours times standard rate minus. So the standard hours minus this times the standard rate minus what was paid, what was actually paid. Actual hours at standard rate, sorry. Not what was actually paid, so no, not that one. So let's go and try this too. Let's go and try this too first. So can you look at the question, try to figure out which one maybe can mimic our formula then. B13 is what? B13, B13. B13 is the direct labor cost. I doubt that one. C9 and C4 is what? C9, C9. Okay, the C9 is the production. Then C4.
Direct labor.
Direct labor. So yes, that one, because the standard hours, we are saying is the hours for the units produced. So the standard hours, you can get the standard hours by saying the units that we produce times the budgeted hours per unit. Then minus 150 times 8 is what? 150 times 8. 150 is what? Is anyone seeing where the 150 is?
No.
Okay, minus 150 times 8. Okay, let's look at the next one. C9 times C4. C9 times C4 minus B13. B13 is what? Direct labor hours. Okay, 150,000 is the hours. 150,000 is the hours. Yes, 150,000 is the actual. These are the actual hours. Because these are the actual results. So 150,000 are the actual hours, and 8 was the rate per hour. So B I think is much closer to our formula here. B is much closer, but however, the way they've used it is a bit confusing. The actual hours here, the AH is the 150,000. Standard rate is the $8.
Okay.
Is the 150,000, the actual hours. Standard rate is the 8. So let's maybe, using trial and error, let's start with that one. Let's try the B one and see. And it's correct. So C9, because C9, we are looking at the units produced times the hours we're budgeting per unit. The variance is not difficult, but the way they have used the C what days, it becomes a bit tricky. Kashida Co uses a standard cost operating statement to reconcile budgeted contribution with the actual contribution. A standard cost operating system for 1 month is given below with some information missing. Complete the reconciliation for the standard cost operating statement shown below. So we need to complete the information. Budgeted contribution, then what is? So from contribution, what follows? From contribution, complete the following reconciliation for standard costing operating statement. Okay, so we are given the contribution. Then from the contribution, they've given us what? What is next? Standard contribution on actual sales. So we have the contribution, then we have the sales variance. So I think here, what we are given, we have the contribution, we have the standard contribution on actual sales price variance. I think this is a reconciliation of sales variances. So this one, it should be
Total sales. Sales volume.
it should be sales volume. The total is 711. So it should be sales volume variance. Because we are reconciling the sales variances here. Because the material variances and labor are here. So this should be the sales variances. Then for sales variance, sales volume variance, the formula is, so to work out the sales volume variance, we say let's go to our Excel. Sales volume variance. It depends whether it's contribution or we are dealing with profit. So sales volume variance is affected by contribution, by whether it's sales volume contribution or sales volume profit. Sales volume variance. So for the sales volume variance, we can say that's the actual volume or actual sales minus the budgeted sales times contribution. Because this is dealing with contribution. So the sales volume variance would say the actual sales. We given the actual sales and the budgeted sales, and also where we given the contribution. Let's go and check. So the actual sales, volume is this 25, is it 25.6? The budgeted is 25,000. What about the contribution per unit? We given the contribution per unit. The standard contribution is 26. Is it 28? The standard contribution is 28. So would say the actual sales 25.6 minus the budgeted sales 25,000 times the standard contribution 28. So this would give us $16.8 favorable. So the sales volume variance, it would be 16.8 favorable. Okay, let's maybe finish up that part tomorrow in our session in the evening. I have another class coming in at 1:30, so I need to prepare their link. So let's wait there for today. So tomorrow we are looking at another different question paper. We'll just maybe finish up this part. Then we are looking at another different question paper. Remember, our lesson tomorrow is 6 to 8. That would be the 4th session. Then the last session will be Wednesday, 6 to 8 as well. So thank you so much for your time for today. I think let's end.